Assalamu alaikum. Today is the general journal. Remember that we have talked about several means that are the books of prime entry. We have mentioned sales journal, sales return journal, purchase return journal, and the cash book. And we said that any transaction that cannot be recorded in these books will be recorded in the general journal. Let's look what's said about general journal. Illegal transactions not recorded in any other book of original entry are recorded in the general journal. So this definition is the formal one, but however we understand that any transaction that cannot be recorded in other books should be recorded here. These transactions means these irregular transactions involve initial introduction of capital by the owner. When the business starts, the first transaction would be paying the capital. Second type of transaction, opening journal to record assets and liabilities. Same thing if assets and liabilities are presented as part of the capital or part of the start. And starting every year we do opening entries. Purchase or sale of non-current assets on credit. If we did purchase or sale of non-current assets on credit. Why on credit? Because if it's cash, it will be recorded in the cash book. Transfer of goods or assets in settlement of a debt. Sometimes you have customers who offer to provide assets rather than providing cash, and this will be entered here. Writing off bad debts. Sometimes customers are not able to repay their debts, and accordingly there is a certain process that will end up to write off the bad debt. Depreciation of non-current asset, and we have a separate session on depreciation. We will see how transactions will be done. And correction of errors, and the last one is transfer at accounting year end to the income statement. In the year end, when we close the books, we transfer the balances of sales, purchase, expenses, and income to income statement. We'll see examples on most of this, with the exception of depreciation, because depreciation is covered in a separate chapter. Recording receipt of an asset in full settlement of a trade receivable. TR stands for trade receivable. So Ali offered a computer of $700 to settle his debt. Let's see how the entry will go. When the business accepts this offer, the following entry is recorded. Date is April 8, and computer equipment is debited because we received the computer, and the computer is an asset. And Ali's account is in the sales ledger, and it is a trade receivable, so it should has a number. So it's credited by $700. And the narrative, which is very important part of any journal entry, say accepted equipment in full settlement of outstanding debt. And you make reference to the letter that was provided and approved. The Ali's letter on April 2. Let's see how this was posted to the ledger. Equipment account on April 8, Ali has provided $700 of equipment, and Ali's account in the sales ledger with his account number is credited with the $700, the value of the computer that he provided and its equipment. Errors correction. Example on error correction. On October 31st, entry was made to correct wrong amount of sale We recorded $100 instead of $1,000, so we have $900 that has to be added to the sales. So we credit cash, $900, and we credit sales. And this cash one will go to the cash book. It's an update to cash book. If you remember what we did in the bank reconciliation, there was a mistake like this. Narrative is saying correction of cash sales of $1,000 entered by error as $100. Narrative is very important part of the journal entry. In the cash book, we have the balance brought forward $5,000 plus the sales of $900. Now it became $5,900. The other side is the sales ledger. Sales, we closed it by $117,000 and we added 900, so it's 117,900. We want to say that journal entries reduces the risk of error and fraud. How would this happen? How would the journal entry reduce the error and fraud? Any error discovered later on can easily be checked against the source document because we refer to the source documents in our entries, so it will be easy to track it. And it reduces the risk of making further errors when posting entries to the ledger accounts. So when we document and record every transaction that we have in the journal, it will be easy to track it. It will be easy to find out the source documents. It will be easy to verify it when you do the posting to the general ledger. Also, it reduces the scope and risk for employees and others making fraudulent false purchases or claim for money owed. So this reduces possibility for employees or others to claim debts or to claim fraudulent or false purchases. It can be passed on to any qualified person or accountant to use to complete full and accurate ledger and final accounts for the business. So if you have complete journal records, you can provide it to any qualified accountant who can do the accurate ledger and do the final accounts for the business. So the main thing is the books of prime entry, including journal. Example on opening entries. Recorded when business starts. Record capital paid by owners. This is for sole traders. We say most of the organization are sole traders, so it will be one owner who is presenting capital. On Jan 10th, there was $5,000 cash paid as capital and open bank account with cash. If you look to the cash book, here, January 10, you have capital and it's 5,000 in the bank. The other side, the credit side, will be the capital, and capital on Jan 10, the bank is debited by $5,000. So we credit the capital account and we debit the cash book, the bank column, with the paid capital. Opening entry for assets and liabilities. Let's see another opening entry for assets and liabilities. On July 1, assuming that the year is starting on July 1, you have premises, you have vehicles, you have fixtures, you have cash in hand, you have cash in bank. All of these are debit. And these are their amounts, and the credit is a capital, $53,600, which means that the owner has presented all these items, premises, vehicles, fixtures, and cash in hand and in bank, for the total of $53,600. There could be another credit here like supplier or bank loan. We can do that. Purchase and sale of non-current assets. Our example here say that we purchased vehicle of 8,500 on January 17, and the creditor is Sun Motors, and the description, the narrative is purchase of delivery van. If you go to the ledger, this is a general ledger for vehicles account, and you have 8,500 Sun Motors. Sun Motors and the GL, this is not a purchase. This is not a purchase account, it's a GL. Remember, this is non-current asset, so it's a GL. When you do the purchase ledger is used only for the goods that we buy for the sole purpose of selling them. Then we have an example of selling furniture. Dina Company purchased furniture from us and the sale of unwanted cabinet. This is a cabinet of $430 and it was sold to Dina Company. Dina Company is in the general ledger as well. This is not sales ledger because this is non-current asset. In April 19th, furniture is credited for $430, while furniture account in GL is credited on April 19th, $430. So when we purchase, we debit the asset account and we credit the supplier or the vendor account, and both are in general ledger. Same thing with sales, but it's opposite. We debit the customer in the general ledger, customer account in the general ledger, and we credit the asset. You will see other entries like this when we talk about disposal of assets and the depreciation. Writing off bad debts. On April 30, there was a decision to write off a debt from Amico, in which is a sales trade receivable, and it has number of 395. Bad debts is debit of $75 and Amico is credit of $75. Debt written off. Final letter dated April 28 and reference is 31-CC. This is very important. This is the document. This is the document that we are mentioning, so you can't repeat using it. If you go to the bad debts, general ledger, it's April 30, it's debit of 75. You go to the sales ledger, Amico's account is started by $75 as a debit balance brought forward on April 1. On April 30, we did this entry, so we deleted the bad debts and credited Amico, so it's closed. This is how we close the bad debts. Last thing that we're going to mention is transfer to income statement. Transfer from ledger to accounts to income statement. Few examples here to tell us what and how to do. On December 31st, assuming that the year is ending December 31st, sales is debit because sales balance is credit. So you need to zero it out so we make it debit and credit the income statement of $70,000 transfer of sales. Purchase is debit, so you debit the income statement and credit purchase. Same date, income statement is debit of $32,000, that's our total purchase from the purchase ledger, and the purchase is credit of $32,000, it's transfer of purchases. Same thing, expense account. In expense account is debit, so we debit income statement and credit it. We used rent here as an example, so with $3,600 credit to the rent, so the rent is closed. With this, we have finished presentation of the general journal. Inshallah, we'll see you in the ledger session. Thank you.